Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Propertybuyer Podcast. I'm Rich Harvey, CEO of Propertybuyer, where we help home buyers and investors make smart property decisions. Today I'm joined by one of Australia's most respected and data-driven property forecasters, Louis Christopher, Managing Director of SQM Research. Louis is known for calling the market as he sees it, without the spin, and backing it up with real numbers. In this episode, we do a deep dive into key market indicators, rental pressure, supply constraints, and what investors are getting wrong. We also discuss government policy, rate cuts, and where the smart money is heading in 2025. If you'd like a clear-eyed view of the housing market from someone who lives and breathes the data, then this is an episode you don't want to miss. Louis, great to have you on the podcast.
G'day, Rich. Nice to be with you once again.
Absolutely. We've had you on the podcast a couple of times and we always get great feedback, so really appreciate your time today.
Good. No, glad I can help.
Now, I've got a tradition with our Thought of the Week, which you know about. I'm going to give you a quote from a very famous American president called Benjamin Franklin, and he says, "I didn't fail the test. I just found 100 ways of doing it wrong." What do you take from that quote, Louis?
Well, I think with anything where you give it a good go at, you will see some initial failure. Most likely, most people do, especially with business. Getting a business going from scratch takes a lot of work, a lot of risk. The rewards come much later, and a lot of mistakes on the way. But you've got to be in it to win it.
That's it.
And, you know, I always like to say to people a quote which I got from a good university lecturer of mine when I was a younger man, and that is that your career or your business and your life is not a sprint, it's a marathon.
Nice. I like that. Yeah, it's a really good quote. Love that. Awesome. Well, it's about having a go. You know, I think failure isn't final for me when I look at that quote. Failure is just a very nice learning curve, right? And
that said, though, I've got to say in this country, when it comes to business failure, we're a little bit tough on ourselves compared to some other countries.
Yeah, we are. We should be more entrepreneurial anyway. Let's get into the data. Look, your company tracks the pulse of the property market nationally. What do the latest trends in listings, vendor discounting and asking prices tell us about where we're heading over the next 6 to 12 months, Louis?
So we just did an update on our June total listings around the country, and they were down by about 7% if I recall the number. That was to be expected because we've now entered into the winter lull period where typically you see a bit of a lull in turnover in the marketplace. You can still have reasonably strong buy demand, but the sellers generally are not there. They're waiting to get to spring. That's why it's called the spring selling season. So at this time of year, you find, yes, the turnover tends to slow down a bit, not as many listings, but it doesn't necessarily mean the buyers are not there. And indeed, when I consider what auction clearance rates are doing right now on our measurement of clearance rates, well, they've actually been picking up to suggest that I think buyer interest has actually been turning up. Not massively so. We're definitely not in any type of housing boom or anything like that, but it's definitely improved from where we were this time last year.
I got interviewed by the news journalists the other day, and they were asking me, Rich, when's the best time to buy or sell, you know, in terms of the peaks and troughs of the market? And I said, well, if I'm a seller, I'd want to be selling when there's not many listings, which is kind of right now, right? During the winter months, late autumn to winter. And best time to buy, spring, when the volume is up. When
the volume's up, there's more choice.
More choice, right? So, but at the end of the day, even that equation, it shouldn't be just based on seasonality as to when you buy. I always say the best time to buy is when you can afford to buy and you know you're going to get something that's going to satisfy your goals.
I think it's really hard to time the market over a small period of months.
Yes.
Very, very hard to do that. Property is meant to be a longer term hold.
Absolutely.
I've always taken a personal view, and I've applied it to my portfolio of holding for 10 years plus.
Yeah, you get the best benefit, don't you?
And it means if you make a mistake at the beginning, you got the pricing a little bit off, it will make up for that over the long term. Obviously, there are times where you need to realise maybe you've made a bigger mistake. You bought the wrong property, and it's best to cut your losses. But that's a general view I have.
Yeah, fantastic. You've recently forecast price growth in your boom and bust reports, sort of growth in the range 5 to 9% in a range of markets.
Yep.
Are there any particular risks that you think could derail that outlook? I mean, are we underestimating geopolitical risks, rate volatility, or supply side disruptions, do you think?
Good question. At the moment, I would have to say our forecast is actually on track. We now have reached a midway point of the year, so we're feeling reasonably good about the forecast we've actually got out there.
So I can tick your report card for this year, mate, when it comes to November.
We'll see what happens. So we've got the second half of the year to deal with.
Yeah.
Let's keep in mind that it's very likely we're going to see an interest rate cut soon, real soon. I think that will spark further interest in the housing market for the second half of the year. So our expectation is that that the housing market will actually pick up further from what we've already seen. The key risks I think we need to consider is a sharp rise in unemployment. That would be the number one risk right now, and that would occur if the economy went into a slump. How could the economy go into a slump? Well, I'd have to say the economy's been a bit patchy anyway to begin with. If you were to have seen a massive rise in oil prices driven by the Middle East conflicts, that potentially could have caused problems for the global economy, which would have spread onto us, affecting unemployment. But touch wood, oil's actually been behaving itself reasonably well. Other base commodity prices have too. That's one of the reasons why inflation has been coming down again, and it's why the RBA is likely to cut rates. So I think the probabilities of something really adverse happening in the market and in the economy for the second half of the year are reducing by the day.
Yeah, right. I mean, I talk to investors every day of the week, and some are saying, "Oh, Trump's a madman," and I'm not going to invest until things will settle down.
But we've had Trump. We've had a Trump administration in the past, from the year 2017 through the year 2020, and look, the guy is. By background, a real estate developer.
Exactly.
He's a bluffer.
Yeah, exactly.
This is what he does. He bluffs, right? And
he's an extreme negotiator.
He's an extreme negotiator. And it does create a bit of volatility, but I think the markets are starting to grow used to his style. And the truth, too, is his style, more often than not, actually gets results.
Okay. I want to ask you about how the RBA is reacting. Do you think it's too slow or too reactive in recognising the influence of the housing market that's having on inflation at the moment?
Well, I think I've said this on your program before, Rich, that I think one of the hardest jobs in the world is to be an RBA central banker, right? The governor. Let's think about it. You're trying to effectively predict the future.
Exactly.
Which is always a hard game, yet I have a go at it from time to time. But, monetary policy does have an impact upon the economy, on people. So you've got to get your decisions right. Look, I think they've actually been pretty good in the scheme of things, albeit a little bit conservative. But they've been responding, I think, overall well to the information at hand. And when the information has changed, well, they've changed their view, and that's what you want to see in analysts.
They're responsive to the data.
They are responsive to the data as best they possibly can. Look, I think overall they've been doing a reasonable job. I
mean, they often use the word jawboning, right? They do a lot of talk, right, in the media to sort of influence markets one way or the other, and everyone picks apart their statements to the nth degree.
That's right.
You look at the Fin Review and it's all highlighted in yellow and bits and pieces working out exactly where they're going to go. So even a couple of words can really shift currency markets and all sorts of bond markets very substantially.
Oh, they can, because if those words become more dovish, the probabilities have suddenly risen that we'll see an interest rate cut. And that gets then automatically priced into the money markets.
That's right. I want to talk a bit about affordability. We've got affordability really, in some ways, hitting at crisis levels, particularly in Sydney and Melbourne. Do you think there's any evidence that this or crisis of affordability is actually reducing demand? Like, are people being priced out, or do you think migration and generational wealth is just going to keep fueling prices regardless?
Oh, there's no question. Many people are being priced out. I mean, the reality is, especially in Sydney, that the average family income no longer buys the average home, and it's been deteriorating for some time. Why has it been deteriorating? Why do prices still go up despite the fact that the average family cannot afford the average home? Because the city has been growing with population at a very quick clip, in large part driven by overseas migration. The migration has been from people who have been cashed up. So they're coming into the country with dollars to spend, and they can buy a home. And that kind of crowds out the market a bit. That's not the only reason. We have definitely been underbuilding as well relative to the population growth. And so, it's a simple supply and demand situation. You increase demand, you keep supply relatively fixed, prices will go up. And they'll go up to the point of that only the most wealthy people can afford it.
Yep.
But if you see a city where the affluent are growing in absolute terms, in terms of number of people, and you've just got this fixed supply of homes, well, yeah, sure. They are going to be the ones buying the homes. And sadly, what that means is, of course, homeless rates go up. People on average incomes live further and further out of the cities, or they have to make a major compromise. So, for example, a family living in a 2-bedroom unit where they've got kids and everyone's really crowded in. To me, that's a statement of a lowering of the standard of living for the country when we see stuff like that.
Yeah, that's it. That's a perpetual issue. So I'd like to unpack sort of the role that investor activity is playing in driving market conditions at the moment. We're seeing a shift in sentiment back to capital cities, or are we seeing a shift of momentum to regional centres? Like, in other words, do you think investors are going to go back for the cities, or they're going to go for the regions?
Demand for regional locations has ebbed and flowed in this decade. When we had the outbreak of COVID, I've never seen demand stronger for regional locations. Everybody was flooding out of the cities to try and get away from COVID, to try and get away from lockdowns, and we saw a boom in regional rents and a boom in regional prices. Then when the lockdowns came to an end and we opened the borders, people moved back into the cities, vacancy rates really tightened in the cities, whereas rents started to slow down in regional Australia. Last year, we started to notice an decrease in rental vacancy rates in the regions once again, which I found rather interesting. And to me, that suggested more of an affordability factor that might be playing out there. But I haven't really seen so far this year a major rise in rents in the region. It's only been growing at the same rate as inflation. And so rental growth, even while we've had a shortage in the market, has actually slowed right down for both regions as well as the cities.
Yeah, I mean, I track your numbers. I also get CoreLogic or Cotality numbers, as they're called now. And, back in the day, it was like 10% growth in rents, and that curve is now coming down to, 4, 5, even 3% growth.
Well, a number of cities, like I think Sydney briefly hit 20% growth in 1 year for rents. Crazy. Perth got up to 25%, Brisbane 22%. Yeah. Melbourne was like in the, I think, high teens, if I recall, at one point. Crazy. Like, these are numbers I don't think we're going to see again for a long time.
I don't think so either. But talking about we were just talking about regions then, and the phrase regional regret just came back to me. I don't know if you saw, there was some sort of study done on about 5,000 people that moved out to the regions when COVID hit. And they were interviewing them as to whether they were happy with the move or not. But a staggering, I think it was like 30 or 40% had decided to move back to the city because they loved it when they were out there because it was an immediate change. But then they missed their family, they missed their sporting events, they missed their network, they missed the convenience. And so there's this gradual pull back into the cities again. And also with employment, you've got a lot of staff being now required to be in the office 4 days a week or more, whatever it is. So there's a lot of that reversal of those COVID trends.
I couldn't have said it better myself, Rich. But I got to say, I am a long-term believer and a housing bull on regional townships in Australia. Now, when I say a long time, I'm talking about long term, beyond my lifetime.
And which are you talking, like, define what you mean by a regional? Because there's like micro-regional and there's large regional. So what do you mean by that?
Oh, probably mid to large regional.
Yeah.
We're talking about townships where there is more than one economic driver in the town.
Yeah.
We must remember that one of the reasons behind the success of the United States, and I qualify that, previous success of the United States, is that the growth of their inland townships. In the 1700s and 1800s and 1900s, the US's regional townships grew amazingly well. And that was because of a diversified economic base, a whole bunch of reasons there, but they had great success in terms of growing their regional townships. And I believe the long-term future of Australia is our regional townships.
Yeah.
It's going to take some time, probably another 50 to 100 years where we'll see these really diverse, large, inner-region townships, but it's happening. Bendigo, for example, has grown substantially. So has Orange. I don't know if you've been out to Orange of late, but it has grown a lot since I was a kid. And these townships will continue to grow.
Yeah.
And so there is an argument there. If you wanted a diversified portfolio, I wouldn't recommend it being your first property as an investment property, to hold a regional property in a township which is growing, has got a very solid economic base.
That's a really good question. I'm going to come back to that in a minute and touch on it in a minute, but I just want to close off this section talking about sort of overseas migration. And we've seen massive amounts of migration. I think it was like 600,000 the year after COVID. And the data's a bit patchy, but what does your tracking at SQM reveal about the real impact of migration on rental demand and dwelling shortages?
Yeah, really good question. Look, there's no, you can't directly quantify the cause and effect there between migration and, say, for example, rental vacancy rates. But we naturally see patterns in the data. And it just so happens that when we opened the borders, rental vacancy rates fell dramatically in the cities in particular. That's probably a combination of factors. One, as we've just discussed, people moving from the regions back to the townships. But two, this strong increase in migration. Now, it is in many respects a simple numbers game, right? If you build across the country for the year, say 200,000 dwellings, but your population has increased by, say, 600,000, okay, well, you only have to put two and two together. That 600,000 needs to live somewhere.
Exactly.
And 200,000 doesn't really cover it. No. And so what happens is people group together more, and that's what's been happening. The number of occupiers per dwelling has been rising, yet rental vacancy rates have still remained very tight because we've just completely underbuilt relative to the population. Now, Rich, I being upfront with you, and not everybody's going to agree with me on this, I have been a strong believer that, resolving our housing affordability issues is a complex affair that cannot be done overnight. But one of the levers we can pull is to cut migration and do it over the short term. In fact, I'm a strong believer that migration can be used as an economic lever. There are times when you put the pedal to the metal and grow migration, and there are other times where you really do need to pull it back. And I believe we've been in one of these times for at least the last 3 years now.
Interesting. We really appreciate you tuning in to the Propertybuyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Propertybuyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast. So Just touching on rental vacancy again, yours has got the best. I've got to say, yours is the best and most closely watched in the country. And we've got record vacancies in many cities. But what's the end game here? Do you reckon we can build our way?
You mean record low vacancies?
Record low vacancies, sorry.
Yes.
Yeah, low vacancies. But can we build our way out of this rental crisis?
It's possible, but it's highly unlikely. Yeah. We've got so many problems on the supply side, which is creating these constraints. We've got red tape at the local level in particular. We've got it at the state level as well. We've got a taxation system which is prohibitive towards supply. The truth of the matter is every time a new dwelling is built, 40% of the price is taxes, effectively. 40%. Government doesn't want to let that go. No. You rarely see that talked about in the media. Yeah. And so they don't want to talk about it. But if we were able to cut taxes by half, that will help a lot. There's quite a few things that need to be done, but there's definitely a supply side constraint. There's no question about it. Now, I think we will see a pickup in new dwellings over the next 12 months. Remember the government's target, though, 1.2 million dwellings for the 5 years through to mid-2029. We're well and truly behind the run rate required.
No, way behind.
It's not going to happen. No, we'll be at least 300,000.
I was going to say, we'd be lucky to crack 900. Exactly
we will be lucky to crack 900.
Yeah. Build to rent has often been put forward as a long-term solution to help the rental crisis. Do you think institutional landlords are going to help or hinder that kind of affordability?
Look, I'm neutral to negative about build to rent, to be quite frank. Yeah. Look, I think it has its place. It's worked well in a number of countries overseas, but there are reasons why it's not working well here. The number one reason is that our rental yields here in Australia are considerably lower compared to overseas. So, the average gross rental yield for, say, a unit in Sydney will run at about, say, 4%, and that's gross. Yeah. A comparable, say, in the United States would be more along the lines of 7%. And it's the same with the UK. The reason why we've got lower gross rental yields compared to our overseas counterparts is our taxation system. So negative gearing encourages lower rental yields. So that's one of the issues. So the reason why this is important is that the institutions need a return on their investment. They get it through a distribution, or in this case, a rental return. But if your rental net return is too low, it's hard to make the numbers work.
They are giving them a 15% tax concession, I think, or it's half the company rate.
They are,
like that.
That's right.
But is that enough? I don't know.
It's not. And then there are other issues. So you recall the National Rental Affordability Scheme, NRAS.
Yes, yeah.
Well, NRAS was really a bit of a flop, right?
Absolutely.
Why was it a flop? Because remember, that was a government initiative to try and get supply going.
That's right.
One of the reasons why it was a flop was you had a situation where you were building dwellings where a number of the units were targeted towards, for lack of better words, not even working families who could barely get to the breadline. And they were trying to mix that up with families that are high middle income earners to stop the slum effect. It didn't work. That notion of that mix didn't work.
Right.
And that caused a lot of problems. It was one of the big reasons why it never really took off.
Interesting. You're a font of knowledge, Louis. Love it. You also produce some fantastic data about distressed listings, and it's particularly a good early warning signal. Are you guys seeing any signs of financial stress that might surprise the market in 2025?
No. It's actually, if anything, our distress counts have gone backwards in 2025. We did notice last year there was quite a pickup in Melbourne, but that seems to have now levelled out. And over and above everything else, the numbers are well down on what we were recording pre-COVID. So we're recording on average about 5,500 distressed listings a month across the country. Prior to COVID, that number was actually towards 12 to 13,000.
And what percentage would that be of the overall market? Like if you said that X percent of listings are distressed, is it like 1%, 2%, 0.5%?
So we recently updated our numbers, and there was about 233,000 listings in the market, and as mentioned, there was about 5,500 distressed listings out of that 233. Yeah. So what's that? That's
less than 0.5%.
Yeah.
So not much. Okay.
Yeah, it's not much. No.
Yeah, gotcha. I want to touch again about regions, and I know we won't talk about specific suburbs for our audience, but let's talk about some regions across Australia that you think are showing really strong fundamentals right now, but maybe they're flying under the radar of the mainstream investors. So you talked about your sort of thought that long term, a lot of the regions are going to perform really well.
Yeah.
I was sort of saying, you're saying they've got to have multiple industries. I'm not an advocate myself of a mining town, for example, to invest in because it's too one-sided. But the sort of regions I like to invest with our clients is Newcastle or Geelong or Sunshine Coast or Townsville. There's some really good markets there. But what's your thoughts? Are there any other sort of regional areas you'd pinpoint?
So we're thinking of what as a 10-year hold?
Yeah, exactly. Yep.
Okay, all right, so I need to, when I say this disclosure, I already have a property in this area. Yeah, so I like the Mackay region.
Yes.
Up in...
yields.
Yeah, absolutely, great yields. Yep. Very, very strong population growth and a council that's actually fairly pro-development.
Yes.
So pro-economy. Yep. So that's a one that I've been holding now since about 2021 and been quite happy with that. Closer to home, we're taking the view with the interest rate cuts that it's likely that we'll see stronger demand for the outer rings of Sydney and Melbourne. So I think we're going to see some outperformance there driven by a lot of first home buyer activity.
Purely affordability. Just
it's
people out to the fringes.
Straight out affordability play. Yeah. Let's remember the rental market's still tight. Rents are still elevated even while the growth has slowed. It's still very elevated. And so if I was a renter now and I had interest rate cuts, I'd be knocking on the bank to see whether I can afford a home. And I think that is going on as we speak.
And what about Central Coast, for example?
Oh, yeah, Central Coast, I think, been really good in terms of a satellite location for Sydney. Increasingly in the last 5 to 10 years, I think if we were talking, say, 20, 25 years ago, it was a real boom-bust type of town, and so far more volatile, but it's less so now. It is definitely less so now. So the volatility that was once there is no longer there. So yes, I think that's another good play for affordability. Same, for example, in the Newcastle area as well.
Absolutely.
So that's one to watch for. Blue Mountains is an interesting one because it definitely is a potential affordability play. And I'm a long-term believer that what we're going to see is the sprawl of Sydney go up into the mountains a bit, especially, say, for example, northwest Sydney. And so we can still see a situation there where, look, property is actually fairly well priced there, especially the large lots, but there is subdivision opportunity in those areas for the long term in terms of Sydney's growth. Then turning to Melbourne, something really interesting is going on there. Melbourne's building better than Sydney at the moment when it comes to units. And at the same time, Melbourne's rental yields for units are the highest we've ever seen it. And so we're being starting to think, is there a potential opportunity there?
Absolutely, there is.
Now, that said, I don't think the Melbourne economy is doing great. You've got a state government there on the verge of bankruptcy, quite frankly. So a lot of things need to be sorted out. But just looking strictly at the numbers, it is sort of flashing that, okay, not a bad time to maybe consider getting a unit.
Well, funny you mentioned that because we're buying a lot of units for our investors in the Melbourne market simply because we're getting them at, I believe, below replacement cost.
Yeah.
Like we're buying them at almost 90% land value, 10%, uplift on the property itself. And it's just, you're not going to buy, and the yields on them are fantastic. Even getting close to 5% on some of them.
But can I ask you a question? Doesn't it concern your investors or yourself about how draconian the tenancy laws have got there.
Oh, well...
And the taxation there as well.
Yes, it is. Yes, the land tax is often a thing used against investing in Melbourne. Having said that, a lot of investors have exited Melbourne. So if you look at the rental bond board, a lot of rental bonds are being paid back, right?
Yeah.
So it's an opportunity in my view. So the land tax is not as bad as everyone thinks. When yes, you're paying land tax from $50,000 threshold upwards, but relatively speaking to the other states, it's like $1 or $2 grand more a year.
You just got to be sure you're going to put a tenant in there, they're the right tenant.
Exactly.
Because it's going to be hard to get rid of them.
Exactly. Well, that's right. That's why you have to get a good property manager. And again, I've got properties in Melbourne, and yes, the laws are there. It's got to be habitable. You've got to have good heating, cooling, smoke alarms. All those boxes have got to be ticked.
Yeah.
It's just what it is. So yes, the laws are more in favour of the tenant, but it shouldn't stop you investing at the end of the day. So I think, again, for me, building out advice for building out a portfolio for our clients, diversify. You don't have 10 properties in Melbourne and none in Brisbane or Sydney. You build across a range of different markets and take advantage of that. Louis, I want to ask you a question about also investors. What common mistakes do you think investors make when they're interpreting market data or forecasts?
Well, there's a lot of information out there, Rich, as you know, and a lot of confusing data indeed, a lot of data which contradicts itself from provider to provider. So straight away, it's difficult for a novice to get their head around all the various bits and pieces of the data that's out there. And in truth, I think what you and I should do one day is go through all the various measurements of the data and what they mean and how to read them and so forth. I think that could be a good podcast.
That could be our next podcast.
There you go.
Okay, perfect.
Look, it's confusing. I would suggest to people that if they want to get measurements of the market, follow the auction clearance rates, but our clearance rates, because they're final clearance rates, they're not spruiked up. That gives you a very good understanding of where the market is in a cycle. Get access to longer term demographics. Careful of data which shows a suburb rising by, say, 50% in 12 months, 40% in 12 months. All that's really happened there is you've just had a situation where in 1 year the lower end of the market has sold, followed by the next year where the top end of the market sold, and it's skewed the median. It doesn't mean prices have really jumped by 50%. So be watchful of things like that. Go out there, get the information, get methodologies. We put a lot of methodologies on our website in terms of what our measurements mean and how they're actually put together.
I'd answer that question about common mistakes is that people have very short-term thinking. They look at forecasts. They might look at your forecast or some other bank forecast and go, Sydney's predicted to do this, Melbourne's predicted to do that, Brisbane will do that, therefore I'll just go with that one. And they're not thinking 10 years plus. They're thinking very short term.
Well, Rich, we've got to remember too, no one knows the future for sure, right? I'm mortal. I make mistakes in the market. And I've got my opinion out there, and we naturally, what we like to do is we state, okay, well, we've got it right and wrong, and these are the reasons why. But it's just another opinion out there, right? It's just an opinion. And I think one of the problems the community has is it just seems to nowadays increasingly overly reliant on what someone's opinion is. Right? It's like, come on, get your hands on the data, read some books that are just factual, and do your research, get educated. Be careful of relying too much on one individual's forecast, including mine.
Yeah, it's really well said. I think it's also, you've got to use the words art and science, right? You've got to ground truth. What I say to my clients, look, we can give you all the data in the world and we could just confuse you. We'll give you options anxiety. But, using a buyer's agent, what we're going to do is ground truth all this data. We know we're on the ground. We're seeing what the actual rents are that's quoted and what it actually ends up being rented for, what the advertised price is and what it sells for. So you've got to do that ground truthing.
The other thing too, Rich, over my life, is I think the market has, especially in our larger cities, has become what I call more efficient. And that is that the information that's known out there gets more quickly priced into the market than perhaps where we were, say, 30 years ago, where you would still have that crazy buyer would come along and pay way over the market. You still sometimes get that, but it's you don't often see that.
Don't get the uneducated buyer.
That's exactly right, because there's so much information out there. There's valuations galore out there and so forth. So to an extent, the market from week to week has priced in all the good and bad news in there.
Yes. Yeah, that's good. Fantastic. I'm going to ask you to quickly get your crystal ball out. If you did have to bet on one capital city, though, outperforming the rest over, say, the next 3 years, what city would that be and why?
Brisbane. And it's because of the lead up to the Olympics, the infrastructure that's going in there, the still ongoing strong population growth. Now, that said, I think prices are starting to get a bit full. They're a bit fully valued, but the momentum is still there. The interest rate cuts are going to ensure that the momentum continues on. We're still not seeing any supply surge in Brisbane occurring. So it's going to be tight for a while on the rental front. So I think all those factors are some of the reasons why Brisbane's going to outperform. But I'm a little bit more cautious on places such as the Gold Coast and the Sunshine Coast, especially the Gold Coast. I mean, this market's looking really overvalued there, like I've never seen before. And I used to be a resident on the Gold Coast when I was a younger fellow. So I've seen the highs and lows of that area. But things are looking pretty fully priced there in that region.
Okay. Well, I'll definitely back you up on your Brisbane recommendation. I've got several properties there, looking to buy another one right now in Brisbane myself. So, definitely going to put my money where my mouth is. I want to ask you very briefly, I know it's a hobby horse of yours, but about government policy. How do you
What
rate...
type of government policy? I've been a bit outspoken on various government policies of late.
But how do you rate the federal and state government's approach to housing policy right now? Do you think there's any kind of serious reform going on, or is it just headline Band-Aid kind of solutions?
I've been a little bit more optimistic of late of what's been going on in Victoria. I think there has been a bit more of a better supply side response from the state government there. The New South Wales government, of course, has been having a go, but I think they've only had mixed results so far, and they're still getting resistance from local councils. It's mixed there. Look, I think overall we need some major policy reform. We need strong taxation reform. We need supply reform. And while that's all going on, we need just to settle down on the migration numbers. And if we were to do those things, I think we would have a more affordable market with not necessarily creating a crash in the market.
Yeah, okay. Yeah, cool. Let's talk about interest rates and credit policy. You've said in the past that property is highly sensitive to interest rate expectations. How do you see borrower psychology changing now that cuts are on the horizon?
Borrower sentiment is definitely improving. We're not at the fear of missing out stage in the market, but I believe more and more people out there looking to buy, doing their research. There are more buyers there on the ground. So I think confidence has been increasing, and it will continue to increase once we see the next rate cut.
Yeah. Well, I think we're going to definitely see a rate cut in July this month, and then I think we'll probably see at least one more before December.
The money market's almost pricing in as a certainty for July.
And we're seeing that definitely our inquiry in our business has definitely risen because people are expecting and trying to get in before a massive flurry. As you say, we're not at FOMO, but we are definitely on the cusp of definitely another, I won't say boom, but another resurgence.
I think so. I think when we see this rate cut, we'll go into the spring selling season. There will be definitely more buyers out there. The sellers will be out there as well. And then, I think we're going to see prices continue to accelerate for a pretty strong 26.
Okay. Are you at all concerned about the growing gap between the cost of building versus market price for existing homes? And what do you think that might mean for developers' feasibilities and their own viability of their businesses?
Well, as stated before, about 40% of the cost of the building is taxes. So it's creating problems in terms of creating new supply. So typically, new homes were built by first home buyers, especially estates and out of suburban rings. They've been harder to move because first home buyers have been struggling to afford these outer ring homes. There's been a movement towards units, of course, but there's been issues on the unit supply side as well, including a bit of a lack of confidence in the quality of some of these builds. So,
Go That's a good point about that. Just pick up on that lack of quality. I reckon that's been a big factor in the off-the-plan market being decimated. Like back in the day when I first started investing, probably like 25 years ago, off-the-plan was still the rage. You could flip properties. You know, I remember buying 4 properties in 1 week and then I flipped them on completion and make good money on it.
Yep.
Right, but it's because you get deposit bonds cheap. You can't do it as easily now.
Yeah.
But the whole quality equation wasn't really raised. There was no such thing as a building commissioner back then. Right?
Yeah, that's exactly right.
And now you've got issues with water penetration. You've got Opal Towers disaster, Mascot Towers fiasco.
Yeah,
you know,
and that's made everyone's aware of those fiascos.
Exactly, and so they're negative about buying off the plan apartments.
Well, hey, when there's a risk of losing half your money or more, who's to blame them?
Yeah.
Now, I think more work needs to be done in terms of improving confidence on that side of the market, and I don't think we've done all the work yet. Yeah, sure, we've got a commission and so forth, but I think developers need a bit of a carrot and stick approach to them. So
there is a new thing just on that. There is a new thing with this strata reform. So you've got to put in, I think developers have got to put in at least 2% of the building value into the strata fund before they start it up. Is that right? I can't remember.
I don't recall that. You would know that better than me. But look, failures are still happening. This is a problem. Maybe not on the scale of Opal. We haven't had one of those in a little while, but they still happen. Look, I think there's a carrot and stick approach that needs to happen with developers, and the carrot being that we get the taxation down on the build so they can build at a lower break-even point, and a stick being that they must build at a higher quality. If they fail on their deliverance, then the government can pierce through some of these legal structures they set up, where they allow themselves to go bankrupt and set up a new entity. We've got to stop that. You really got to stop that. I think that's one of the issues that that's still hanging in the air.
Okay. Now, Louis, your boom and bust report is excellent. I buy it every year and highly recommend it to our clients, and it's very widely read. But what's the most misunderstood part of your forecasting model? What do they misread in your report?
Our scenarios. So you know how we do
you do your 4 scenarios.
They say
scenarios.
It's a
cop-out, right? But
it's pretty tough because what we do is we say this is our base case.
Yes.
So the reason why I do scenarios like this is because I actually got rather sick of the industry in putting out, say, a single forecast, and then when they're getting it wrong, you'll hear them in the media, say 3 or 4 months later, and they say, here's our forecast for the year.
Forecast.
Well, they won't even use the word revised. They'll pretend as though this is the forecast, brand new forecast. Okay. Yeah. And I found that very misleading. Yeah. And so what I wanted to do is say, all right, I'm not going to do revisions. What I'm going to do is scenarios. Yeah. And, take into account factors where, all right, yes, I'm strong on in terms of property markets, but things which perhaps I'm not the expert on, such as the future direction of interest rates, the future direction of the economy and so forth. Yeah. And so what I do then is, okay, well, I factor in these scenarios. What if the government decides to cut migration by half? Yeah. What would that mean for housing prices? So that's how I map these things out. Yeah. Now, as you'd be well aware, each year I state in our boom and bust report where we got it right and wrong from the previous year and which scenario came in. And I give myself the most points if our base case scenario comes in, and I give myself the least points if, say, scenario 4 comes in. Yeah. But it's more about educating and okay, if we've got it wrong, that's cool. I think people respect you if you're transparent enough to put your hand up and say, Absolutely. Hey, we got it wrong. Yeah. Then the question is, why did you get it wrong? What is it with the economy that you've learned that's now affecting the market that perhaps wasn't having such an influence on the market 5 years ago? Is there another X factor
that we haven't thought about that suddenly hit us?
That's exactly right.
Is it an avian bird flu? Is it another shipping container crisis or whatever it is?
That's exactly right. Yeah. So that's how I go about doing it. I'm not trying to do it to cover all bases. I don't jump up and down and say, hey, we were right if my scenario 4 comes in. We make it pretty clear when we talk, saying, yeah, scenario 4 came in. These were the reasons why our base case didn't come in this year.
Cool. Louis, I've got one more question about data to ask you. Is there any one big trend or a signal that you're watching in the data that most people aren't talking about, but they should be? Is there any kind of signal out there that you think they should be focusing on more?
Good question. Okay, so in terms of leading short-term signals, I'm watching the auction clearance rates, our auction clearance rates, very closely for Sydney and Melbourne, because I've definitely noticed an uptrend in the clearance rates now for both cities for this year. So they're now hovering in the 50s mark, whereas this time last year they were in the 40s. And since we've now breached 50% on our measurements, that definitely means that housing prices are rising. Not booming, they're rising by single digits. Now, if we were to see clearance rates start to get to the high 50s, then that's telling me the market might be starting to get up in terms of annual price rises towards 10%.
Okay. Can I just ask, because your figures are very accurate. Yours are the, estimated like at the end of the week, not on the Monday morning or the Sunday afternoon, right?
Yeah, so we're trading off timeliness versus accurate.
So your 50%, does that equate to like a 75% quoted auction clearance rate in Domain, roughly?
That's a hard one. Like they because their preliminary numbers are so volatile.
I tend to find when I look at it, I would say it's probably a 70% quoted number, roughly. It equates to your 50.
Roughly. I think roughly that would be correct.
But your point you're making, though, is that we're definitely seeing a rise in auction clearance rates. We're actually seeing a lot more people on the ground at auctions bidding, and we're definitely seeing more competitive tension. So, again, that just means prices are definitely on the rise. Yeah,
I agree. And that's the point I'm making, is that the weekly auction clearance rates have really helped me in the past in terms of picking markets, and definitely they are giving off signals now that Melbourne and Sydney are about to pick up in pace.
Great. Well, Lou Christopher from SQM, how can people find you? What's your website?
sqmresearch.com.au.
I'd highly recommend people go there, any listeners out there. It's fantastic research, very rigorous. Really, thank you so much for your time, sharing your knowledge today. It's been great to have you on the podcast.
You're welcome, Rich. Always a pleasure having a chat with you.
Thank you so much. And we'll look forward to seeing you again very soon on another edition of the Property Buyer Podcast. Bye for now. Thanks for being with us on another Property Buyer Podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.